Hey everybody, it's Paul here from Blossom on my YouTube channel, Better Call Paul. This is my real life case study update. This is episode 6 or 7, I believe. And the information in this update comes from September 30th. So this is the end of September update. Essentially, guys, this case study is my attempt to prove that covered call ETFs are sustainable. So a covered call ETF portfolio yielding just over 30% will last indefinitely and be able to provide you with a high level of monthly income. So I put together this case study back in May. I started it in June, taking out $1,000 a month from a portfolio with just over $55,000 in it. So the portfolio itself is producing approximately $1,600 a month in distributions or dividends. And I'm taking out $1,000 and I'm reinvesting the difference. And each month, I go over what my portfolio balance is, if I made any purchases, the $1,000 withdrawal, and just to see where we're at. Now, I understand this is only 4 months, right? It's only 4 months. It's been a pretty strong market. It's been a healthy market. But at the same time, everybody argues that covered call ETFs will capture all of the downside, not all of the upside, and that you're only getting your money back. It's all return of capital, bad rock, and that it's not sustainable, especially with a 30% yield. So let's take a look and see where we're at as of September 30th. So here you can see, guys, we'll just go back and look. In January, my balance in this portfolio was just over 48,000. It went up to 49. You can see it dropped significantly to 45,000. And then it went up a little bit to 47,429. By May, it was at 50,900. By June, it was at 58,000. By July, it finally hit a high of $60,960. By August, it dropped down to 55,447. And now on September 30th, my balance was $58,940. So if you take a look at the 9 months of 2025, my average is 52,719. So right now we are well above the average, okay? And you have to take into consideration, if you look here under withdrawals, right? I withdrew $1,000 in June, another 1,000 in July, August, and September. So that's $4,000. If you add that $4,000 back into the current price of 58, or the current portfolio balance of 58,940, now you're at 62,000, right? So it'd be a lot higher. But the nice thing is with a passive income portfolio, you can take the $4,000 out and you can spend the money. You can enjoy it, right? So total distributions to date are 11,320, and I currently have $204.90 sitting in the account waiting to be reinvested. Now, just to show you how quickly things can change, okay? On October 1st, we had a green day. And now my portfolio, as you can see here, is $60,189. So even though this is a covered call ETF portfolio, even though I withdrew $4,000, my portfolio now is back up above $60,000. And I think the all-time high was around 63,000. That would have been when MSTE was up around $18 or $19, and probably CNYE was also up around $17, $18. But I cannot complain at all. $60,000, when you look at yesterday, I was at $58,940. Now it's October 1st, so most of my positions, if you look here, you can see that my newest position is Biggie. I only have 23 shares. I still have CNYE from Harvest, HHIS, MSTE, NVHE, TSLY, and ALTI. All are, oh, well, most of them are going to pay probably between the 7th and the 9th. Um, the exceptions being Biggie pays, Biggie here pays twice a month. So I'm going to get two distributions or two dividends in October. And Alti, as you know, pays on a weekly basis. So I'm going to get my Alti dividends 5 times in October because there's 5 Fridays. So October is probably going to be one of my best months thus far. Alti is still negative in terms of share price, and so is MSTE. But everything else is currently in the green. So I would have to say that if you take a look at this case study that I developed in May, okay, and I've been pulling out $1,000 every month, June, July, August, and September so far, has proven that covered call ETFs are sustainable. Um, the distributions do fluctuate, right? MSTE went up, went down, right? Alti, every week there's a different distribution, but for the most part, it's very consistent. It's an extremely high yield of over 30%. I've been able to take out $4,000 and use that money for whatever I want. And at the same time, I'm still reinvesting. So I'm still maintaining my income, growing it a little bit, and being able to enjoy the money that I have as opposed to trying to grow this portfolio until I'm 65 and then enjoying the money, right? I'm only 52, so I get to benefit from this type of investing now instead of later on down the road. And I think for anybody who's into income investing, you all understand the whole purpose of this and the reason why we do it. Okay, I'm not worried about having $2 or $3 million when I'm 65 or 70 years old. I'm worried about having income that I can enjoy now and for the next 20, 30 years, right? Even though it might end up being a smaller portfolio, it's a much larger amount of income on an annual basis. And I think right now, with everything being almost at all-time highs, I will probably take my dividends in October and hold on to once I pull out the $1,000, I'll probably hold on to the excess cash for a little while because I feel that we're going to see a pullback, right? Things can't be all-time highs forever. The market doesn't work that way. Something will trigger it, hedge funds or some political news, or people just decide that the market's too high and they want to cash in profits, and we'll see a pullback. So I'm going to be patient. I'm going to wait a little bit. And when the pullback occurs, I'm probably going to add to my biggie position or maybe start a new position. But guys, if you enjoy this kind of content, you're an income investor or you're interested in income investing, like myself, you're over the age of 50 or even over the age of 40 and you want to retire sooner than later, please like, subscribe to our channel, and leave me a comment down below. Let me know what you think of the case study. Do you believe it's going to fail sooner than later? Is it going to continue to prosper? Or, what are your thoughts? As always, guys, this is not financial advice. You have to do your own due diligence, figure out if this is going to work for you, right? For your lifestyle, for your goals. If you have to, speak to a financial advisor. But otherwise, guys, until next time, bye for now.